Profit maximization. So firstly, we should know the meaning of profit maximization. In economic theory, people play two main roles in the market. As we have just seen, they are consumers. The other main role is that of producers. For producers, the economic problem is to maximize profits. The key decisions are which outputs to produce, how much of each output to produce, and which inputs to use to produce the outputs. We will take these decisions one at a time. Profit maximization is the process by which a firm determines the price and output level that returns the greatest profit. There can be various types of profit: gross profit and net profit, normal profit and supernormal profit, accounting profit and economic profit. Gross profit is the difference between sales and cost of sales. Cost of sales is the purchase price of the goods to be sold together with the cost of getting them ready for sale. For example, a manufacturer would charge production labor and some overheads to gross profit. Net profit remains after all expenses except for profit tax have been charged to the gross profit. These may include staff salaries, rent rates, motor expenses, auditors' remuneration, etc. Normal profits are the minimum that is required to induce a firm to continue to operate. In this case, total revenue just equals the opportunity cost of the firm's activity. Profits that exceed the opportunity cost are referred to as supernormal profits. Any number of short-term factors can generate supernormal profits, but most economists hold that in competitive markets, competition between firms erodes supernormal profits in the long run. A company's total earnings includes the explicit costs of doing business, such as depreciation, interest and taxes, which is called accounting profit, while the difference between the revenue received from the sale of an output and the opportunity cost of the inputs is called economic profit. Economic profit equals to total revenue minus explicit costs plus imputed costs. After studying this lesson, you should be able to identify different types of profits, analyze the condition for profit maximization, analyze the concept of break-even. Now let's discuss profit maximization and its planning. Today, profit maximization refers to the long-run periods, to management's rather than to owners' income, to include non-functional income to restrain competition, to maintain management control, etc. Today, firms set profit standards through a percentage on sales or a reasonable return on investments. It is necessary to set different standards for different companies and purposes, since they give widely varying results depending on market conditions. The business firms pursue a variety of profit policies to achieve different goals, like to attain industry leadership, to forestall potential competition, to prevent government intervention and restraints, to maintain and foster consumer goodwill, to control wage increases, to avoid risks threatening the survival of the business firms, to maintain the liquidity of the business firm. After discussing profit maximization, let's discuss profit planning. Two concepts to be discussed under here are profit measurement, mathematical derivation of equilibrium of the firm. Profit is calculated as rate of return on capital equals to net profit into 100 divided by fixed capital. If this figure is too low, then firms have to check their all operations to find out their weak points. They have to find out the ways to improve current figure for profit. For this, we need to analyze cost and revenue. Cost and revenue analysis provides you with the financial and operational information needed for making good management decisions. These analysis helps you to take a closer look at the efficiency of your existing programs and identify changes to improve cost efficiency. Cost and revenue analysis also helps you to explore the potential impact of your management decisions. Cost and revenue analysis can help you determine how to reduce costs in order to ensure the long-term viability of your organization, how to produce the greatest total increase in your revenues relative to your costs, the most cost-efficient process for delivering your services. Through watching the diagram, we can see that how total cost and revenue analysis leads to estimation of profit. Equilibrium of the firm by curves of total revenue and total cost profit is the difference between TR and TC. Thus, the firm will be at equilibrium at the level of output where the difference between TR and TC is the greatest. Equilibrium of the firm by marginal revenue and marginal cost. The firm will be making maximum profits by expanding output to the level where MR equals to MC. Now let's discuss short-run break-even in detail. Break-even analysis is used to examine the relationship between the total revenue, total costs, and total profits of the firm at various levels of output. It is used to determine the sales volume required for the firm to break even and the total profits and losses at other sales levels. According to the analysis, break-even point is that volume of sales where the total cost of production equals total revenue. It is, therefore, a point where losses cease to occur while profits have not yet begun. For this reason, this point is also known as the point of zero profit. Such analysis allows the firms to determine at what level of operations it will break even, earn zero profit, to explore the relationship between volumes, costs, and profits. It helps the management that at current costs of products, how much number of units must be sold to at least recover the cost of producing the product. Estimates the point in time for investment. The break-even analysis is based on certain assumptions, namely, all costs are either perfectly variable or absolutely fixed over the entire period of production, but this assumption does not hold well in practice. The volume of production and the volume of sales are equal, but in reality they differ. All revenue is perfectly variable with the physical volume of production, and this assumption is not valid. The assumption of stable product mix is unrealistic. After discussing this, all we can ascertain the advantages of break-even. Easy to understand. Profit and loss are easy to understand at different levels of output. Forecasting can be done easily. Like others, it also has some disadvantages, which are: it assumes that all output are sold. Conclusion can be accurate only if data is accurate. Price and cost are assumed to be constant. After discussing break-even point in detail, now we should discuss methods to calculate break-even point. The two methods are the break-even charts, the algebraic method. The break-even chart. In its simplest form, the break-even chart is a graphical representation of costs at various levels of activity, shown on the same charts as the variation of income or sales revenue with the same variation in activity. The point at which neither profit nor loss is made is known as the break-even point and is represented on the chart below by the intersection of the two lines. In the diagram above, the line OA represents the variation of income at varying levels of production activity, output. OB represents the total fixed cost in the business. As output increases, variable costs are incurred, meaning that total costs, fixed plus variable, also increase. At low levels of output, costs are greater than income. At the point of intersection P, costs are exactly equal to income, and hence neither profit nor loss is made. Break-even analysis can also be performed algebraically. Total revenue is equal to the selling price P per unit times the quantity of output or sales Q. That is, TR equals to P dot Q. Total costs equal total fixed costs plus total variable costs, TVC. Since TVC is equal to the average per unit variable cost, AVC, times the quantity of output or sales, we have TC equals to TFC plus TVC, or TC equals to TFC plus AVC dot Q. Setting total revenue equal to total cost and substituting QB, the break-even output, for Q, we have TR equals to TC, P dot QB equals to TFC plus AVC dot QB, or TFC equals to P dot QB minus AVC into QB. TFC equals QB dot P minus AVC. QB, the break-even output, equals to TFC divided by P minus AVC equals to TFC divided by ACM. The denominator in the above equation, that is P minus AVC, is called the contribution margin per unit, ACM, because it represents the portion of the selling price that can be applied to cover the fixed costs of the firm and to provide for profits. Now let us check if we have understood the various concepts discussed in this lesson clearly. Normal profits are the minimum that is required to induce a firm to continue to operate. Right or wrong? Right. Economic profit equals to total revenue minus explicit costs. Right or wrong? Wrong. Rate of return on capital equals to net profit into 100 divided by fixed capital. Right or wrong? Right. Equilibrium of the firm by curves of total revenue and total cost profit is the difference between TR and TC. Right or wrong? Right. Now let's revise the whole concept. Profit is the reward of the entrepreneur rather than the entrepreneurial functions. There are several types in which profits can be categorized: gross profit and net profit, normal and abnormal profit, and accounting and economic profits. Profits are excess of total revenue over total cost, where total costs include both explicit and implicit costs. First order condition for profit maximization is MR equals to MC. Break-even analysis examines the relationship between the total revenue, total cost, and total profits of the firms at various levels of output. Break-even analysis can be performed using two methods: break-even charts and algebraic method.